Hello everyone, Colby Cox with Global America Financial. Welcome to GAF University. Today, we're going to look at the Agility 7 and 10 from Athene. We're going to look at a quick overview of the product, show you how to illustrate it with the software, and then take a look at an example illustration. So let's get started. Okay, so the Athene Agility 7 and 10 are pretty much the same product. There's just a few differences, such as how long you have to wait until you can access the income, the withdrawal charge schedule, the strategies, but everything else is pretty much the same. Okay, so the owner and annuitant age, the issue age is 40 to 83 for the 7 and 40 to 80 for the 10. Ownership, if it's an IRA, must be single ownership, but joint payout is available for spouses. And if it's non-qualified, you have owner and annuitant have to be the same person unless the owner is a non-natural person like a trust. If there are joint owners, they must be natural persons and they must be joint annuitants. Also, joint annuitants must be spouses. Premiums, the minimum is $5,000 in the state of Texas, as you can see here. And then the withdrawal charge schedule is for the 7, it is a 7-year withdrawal charge surrender starting at 9, going all the way down to 3, and then in year 8 you can see is 0. For the 10, it's 10 years, and it goes from 9 all the way down to 1, and then in year 11 it is 0. So taking a look at a few of the features, free withdrawals, you can get up to 10% without penalty. Okay, that is based on accumulated value, not income based. We'll talk about that here in a second. It has two riders, the terminal illness waiver and, excuse me, not riders, waivers, the terminal illness waiver and the confinement waiver. Okay, the terminal illness is where you can draw up to 100% of your annuity's accumulated value if you are diagnosed with a terminal illness that is expected to result in death within 1 year and you meet the eligibility requirements. Okay, this waiver is available after your first contract year, so you have to wait 1 year before you can access it. You may not be diagnosed during the first contract year. Additional limitations, state variations, and exclusions apply, but you got to look at a brochure for that. The confinement waiver is after the first contract year as well. You can withdraw up to 100% of your annuity's accumulated value if the annuitant is confined to a qualified care facility for at least 60 consecutive days and you meet the eligibility requirements. Confinement must begin after the first contract year. And the same limitations and variations apply. Now notice in the state of Texas there is no waiting period. So terminal illness confinement, they go into effect immediately. You do have a bailout feature that if Athene lowers the declared 1-year point-to-point index strategy cap rate below the bailout cap rate, you'll have full access to your annuity's accumulated value. So they have a certain rate that if it goes below, you can access all of your money, okay, free of any charges for up to 30 days. The market value adjustment is just applied to the proportion of the withdrawal or surrender that exceeds the free withdrawal amount during the withdrawal charge period, and then the death benefit is either the greater of the accumulated value and the minimum guaranteed contract value, or you may elect the enhanced death benefit amount, which we will talk about here in a second. So this is the income and death benefit rider. The beautiful thing about it is there's no charge, okay? A lot of income riders have charges on products with many carriers, including Athene, but this one, no charge, okay? So you get that income. The caveat is you must wait the waiting period. So if you have the 10, you got to wait 10 years. You wait, if you want the 7, you've got to wait those 7 years. This rider goes into effect ages 40 to 83 and 40 to 80, just like the issue ages here. The benefit-based bonus is 25%. So if you remember from previous videos that we've done here, there's the income side and then there's the accumulation side. Benefit base is on the income side, so you only get that 25% on the income side. So if you never take an income, you'll never see that extra 25%. But again, this product is designed for income. So if you're selling this, or if you have this, more than likely that's what you're using it for. The benefit-based growth is equal to the initial premium plus the benefit-based bonus amount. On each contract anniversary, the benefit base will be credited 175% of the dollar amount credited to the accumulated value. Okay, during the income phase, the benefit base will continue to grow by 175% of the dollar amount credited to the accumulated value, and that's how it makes an interest or a growth on the income side. Remember, on the accumulation side will be based on whatever the market does, and we'll look at those strategies here in a second. The minimum attained age for lifetime income is withdrawals is 50, so you've got to be at least 50 to access that income. All withdrawals will reduce the benefit base by the same percentage that the accumulated value is reduced. So if you do take out some money before the income, it is going to reduce the income side of it as well, and your income is going to be lowered. Okay, and then for the lifetime income waiting period, again, if you have the 10, it's 10 years, and if you have the 7, it's 7 years. So you're not paying a charge, but you've got to wait at least 10 or 7 years to access that income. Okay, so although you're giving up that ability to access income earlier, you're not being charged for it. The enhanced death benefit is the benefit base is paid out in equal payments over the currently declared death benefit payout period. The death benefit payout period is currently set to 5 years and is guaranteed not to exceed 10. So again, you can get the enhanced death benefit instead of the accumulation value if that is what your beneficiary decides. Enhanced income benefit availability and qualification. To qualify for the enhanced income benefit, the person for whom life income withdrawals are based must be confined to qualified care facility for 180 out of the last 250 days. So this is another rider where if you're confined to that facility for that amount of time, you can double your income, and we'll look at that here in a second when we take a look at the illustration. Okay, so the last thing we're going to look at is the strategies. We have the 7 and 10 strategies here. They do vary a little bit. The strategies are the same. The participation rates and the caps are different. So if you have the 7, we're looking at the first column. Agility is the second. So one thing that the agility has is a lot of strategies with participation rates. And remember, what participation is what percentage you participate in the growth. So if you have a 90% participation rate and the market does 10%, you get 9 because you participate in 90% of that full rate. If you're at 90 and the market does 1, you get 0.9. So you get whatever participation rate you have, you get that percentage of the percentage growth. Okay, so we're looking here at the BNP Paribas Multi-Asset Diversified 5 Index. With many of these strategies, and actually all of them, they have a 2-year and a 1-year. With the 2-year, you have to wait 2 years before you see what that growth is, okay? So if you have clients that don't want to wait that long, maybe not that strategy is not right for them. They also have a 1-year where you only have to wait every 1 year, every year to see what that growth is. So the 2-year, there's no cap. Participation rate is 80 on the 7, and on the 10, it is 90. Okay, so you'll also notice that the 2-year caps are a little bit higher than the 1-year caps because the 1-year participation is a 60% on the 7 and a 65 on the 10. You have an equity no cap, which is the NASDAQ FC index and the AI powered US equity index. Okay, the 2-year on the NASDAQ is 55 on the 7, 62 on the 10. 1 year is 37 on the 7 and 42 on the 10. And then with the AI, you have 65 and 50 for the 2 and the 1, and then on the 10 you have the 72 and 57. And then you have an equity cap, which is the S&P. So this one's not participation rate, this one's a cap. How does a cap work? If your cap is 5 and the market does 10, you get 5. Okay, if your cap is 5 and the market does 2, you get 2. So you're going to get whatever the market does up to that cap. So the 2-year cap is 5.75 on the 7 and 6.25 on the 10. On the 1 year, it's a 2.75 and a 3. Now notice the bailout cap rate. Remember that bailout cap rate is if that rate goes below that 0.5%, both on the 7 and 10, you have access to all your money without those fees and surrenders for those 30 days. The fixed account is a 1.3 on the 7 and a 1.4 on the 10. And again, you have to wait the withdrawal charge to get the income. You have to wait the waiting period to get the income, and the 7 and 10 will also determine how long your withdrawal charge is. So for the 7, it's 7 years, and for the 10, it's 10 years. Okay, so next we're going to take a look at how to illustrate this using the Athene software. Okay, so we have our client here, Oscar the Grouch, a male, 62-year-old in the state of Texas. I'm going to go with the Athene Agility 10. Remember 10, 7, pretty much the same with a few different changes to surrender and charges, but I'm just going to go with the 10. Let's say it's a qualified account, okay, that he's going to be rolling over. The income riders are already attached. We're just going to go single life, okay, income based on Oscar, and we're going to input the premium. Let's just say he's got $250,000 in an old 401k. Okay, so I'm going to put in $250,000. Premium strategies, here's where we go to put the allocations. Okay, so notice it's automatically default to 100% fixed. Now we don't want that. We want to take advantage of the indexing strategies. Look, there's really no rhyme or reason or preference to these strategies. You just put the ones that you like. Okay, if you want to go with the ones with the most potential, go there. If you want to go with the ones that perform the most consistently, go there. If you're just really big on the S&P, go there. Okay, so you just want to diversify this $250,000 or whatever value you have, so that way we're taking advantage of these strategies. So I'm just gonna put in some random strategies here. So let's go 10% in fixed. Let's go 20 in the S&P 1 year. Let's go in the BNP BNP Paribas the 2 year. I'm gonna go 20% there. I'm gonna go 20% in the AI. Okay, I'm going to go 10% here, 10% here, and then I'll go 10% there. Okay, so again, I'm just putting the strategies because I want to diversify. Again, depending on your client, you might want to really diversify or keep it pretty simple. I'm going to diversify it up for this client, okay? So that's 100%. We click OK. So the most recent 10-year ledger, I just go actual average. That's default, so I leave it there. And then historical, same thing. For my quick quote, I'm going to go 72 because I already know I have to wait till at least 72 because you got to wait at least 10 years to get that income. Okay, so I'm going to go to 72 for my quick quote. Now we go to income planning. Okay, so income planning is where we're going to put the income that the client's going to receive, when, how, and what age. Okay, so we're going to come right here to lifetime income. We're going to change this to, we'll keep it annual. You can change it to monthly to show them that, but I'm going to keep it annual. And then the lifetime income right here, maximum lifetime income at age 72, that's default. You could change that to 75. You could change that to 78. It doesn't matter, but it's going to go at least to whatever that default 10 or 7 years is. And then the enhanced income, remember, that's where if you're confined care for that 180 days, you can double that income for a certain time period. We're going to go confinement. I'm going to go 72 as well. You could change that to 73 or 74 to show the client that as well, but I'm going to keep it at 72. Okay. And that's it. That's how you illustrate it. So next, let's take a look at the actual illustration. Okay, so here's the actual illustration. First page is Athene, what product it is, who is it prepared for, prepared by. Second page is looking at Athene in general. Okay. Next page is the illustration explanation on the strategies, telling you what the cap is, what the participation rates are, and things like that. We scroll down to the next one. This looks at the reduced risk of a 0% interest credit. What does a hypothetical strategy look like for the 1-year strategies, and what is your percent chance of getting a 0 with that strategy? And here it is. So most strategies are pretty low chance of getting a 0%. The next one's the same thing, but for the 2-year strategies. Okay, and then we get to the actual illustration. Now, I like to look at guaranteed. Guaranteed is worst case scenario. Market from this point forward does nothing. What is that strategy? What does that plan look like? And then we'll take a look at a hypothetical based on the last 10-year average. Okay, so notice the benefit base is 313, because remember, benefit base is for the income, which is why it's gone up, because it does have that bonus. Okay, and depending on when you take the income, it will determine what that 175% multiplier does. Okay, and so if the market from this point forward does nothing, beginning at 72, 73, this client would get $17,434 every year as income. That is their lifetime income right there. Now remember, if they need the enhanced income benefit, you got to meet those eligibility requirements, which we've already looked at. They would get another $17,434, so they'd get $34,867 if they qualify for the enhanced income benefit. Okay, now that's not the terminal illness, that's not confined care. Those are two other waivers. This is I'm confined 180 days, or I'm sorry, 180 days out of the last 250. Okay, and they'll double my income, and they'll double it, notice here, for 7 years, okay? So for 7 years, you can get double, and then after that, you'll lose that enhanced income, but you'll continue to receive the 17,000 income, okay? Now, these are the guaranteed values. As long as your client lives, they'll continue to get that income, okay? But if they pass away, there may be something left for their beneficiaries, there may not. So here's that death benefit. So if I use my income that first year and then I pass away, 216 is what's left for my beneficiaries or my heirs, okay? If I wait though, not wait, but if I pass away at 82, I'll still be getting income till that point, but there'll be nothing left for the beneficiaries, okay? Because I've used everything with that income, okay? Now we go to the next page. There's guaranteed still. So we go 2 pages. Here is the non-guaranteed. This is what is projected to do based on the 10-year average. Okay, so notice benefit base has gone up a little bit because the growth has gone up. Notice that my income has gone from 17,000 to 28,000. So this is where you can show them and be like, look, if the market performs on average like it has over the last 10 years, instead of giving 17,000, you'll get $28,000 every year for as long as you live. Okay, and then the income starts. Okay, so 28,191 if that were to happen. But notice again, if in 72 your client decides, you know what, I don't need that income right now, okay, and they wait, their income goes up. Okay, so just because they can enact the income after the 7 or 10 year period doesn't mean they have to enact it. Okay, that's just how long they have to wait before they can. Okay, and so you can see the lifetime income, you can see all the cumulative withdrawals. After 10 years, the client's already taken over $500,000, okay, because of that lifetime income. And then you can see again death benefit, cash surrender, and accumulated value. So all the next page is just another scenario with different values. Notice it's roughly the same, but it's pretty much very similar. It's just different strategies if they were to perform differently. Notice this is a 3.72 assumed, while this one up here is a 3.76. So not a lot of difference, but depending on what rate it makes, because this is a 0.04 difference, can determine how much income your client would get. Okay, this is the historicals. Okay, so we're looking at most 10 years. Then we're looking at the middle column is highest 10 years, and then we're looking at the lowest 10 years and what that accumulated value has done. Notice from the highest to the lowest, it's a 50K difference. So even with the lowest 10-year average, okay, you can see here, other than that year right there, maybe in year 4 right there, these are pretty low percentages. We still have some money in there, okay? We're still making some interest because we know that over the time, the market does tend to go up. So we take a look at the next page, same thing, the historicals, but we're looking at what the markets did in the most recent 10 years, highest 10 years, and lowest, and you can see the average. So the most recent 10-year for the S&P was 196%, 98%, that's pretty good. The highest was 308 from 359 to 3519, 308% growth. The lowest was 131 to 130.11, and it was -7. So we know there's going to be ups, we know there's going to be some downs with this product. They're not going to lose because it's indexed, but you can see what those comparisons are here. The rest of the illustration is a lot of definitions, talks about market value adjustment, talks about the different strategies, the different waivers, and so that's pretty much it. Very simple to explain, very simple, very straightforward, a lot of disclosures and disclaimers, but that's pretty much the Athene a 10, and the 7 is going to be very similar in illustration, okay? But again, it's just a few of those different strategies and waiting periods that you have that are the difference. And that's the Athene Agility 7 and 10. If you have any questions, comment on this video, send us a message. Make sure you subscribe to our channel so that way you don't miss any of the new videos coming out over the next couple weeks. And you all have a great day.